Good day to each and everyone watching me wherever you are watching me from. This is Fin Account, and today I'm going to take my time to take you through the preparation of financial statements of a sole proprietor. So when it comes to the preparation of final accounts of the sole proprietor, basically we are going to study the preparation of the income statement and the preparation of statement of financial position. Every business has the motive to go or to make profit or to try and earn profit. So one of the ways the sole proprietor is going to use to actually measure or determine his or her profit is through the preparation of financial statements. Under this topic, we are going to learn the preparation of two main financial statements consisting of one, the income statement, and two, statement of financial position. With the preparation of the income statement, this statement is going to help us determine the profit or loss of the sole proprietor, and the statement of financial position is also going to help us determine the finances of the entity or the sole proprietor at a particular point in time. Let me give you one trick. Under the preparation of the income statement, you are not going to see any asset, liability, or equity. All the items that you are going to see under the preparation of the income statement, they are two: items of income nature and items of expenses nature. And therefore, if you see yourself bringing an asset or liabilities or equity types of items into this statement, then you are getting it wrong. So the preparation of income statement will bear in mind that there are two main elements that you are going to use: income related items and expenses related items. So I will take you through the basic format of the income statement before I come to the statement of financial position. It's not difficult, and don't try to memorize it. I want you to open your mind like someone who is selling, or when we were in class 3 or class 4, the way they taught us how to determine profit. So in class 3, class 4, class 5, we were being taught that for you to determine profit, the equation is simple. Profit is equal to selling price minus cost price. In accounting, you are not going to see selling price. The selling price in accounting is known as sales, and the cost price in accounting is known as cost of sales. Good. Let me start the format. Before you can sell something, it means you have to go and buy. So in this preparation, what I want you to understand is that before we can get our profits, then we must know the sales. So the first thing that you see in the format is sales, meaning the amount of goods that you sold. After getting the sales, you have to understand that at this level you are, whether you are a professional person pursuing accounting or you are doing accounting as a first timer, we assume that you have appreciated in logical analysis, and therefore when you make a sale in a company, there can be the possibility that some of your customers will return some of these goods that you've sold to them, and in returning the goods to you, we classify them to be return inwards. So within a particular period, let's say in 2022, you made a sale, total sales of 20,000. It can be assumed that not all the sales that you made were in the right position, or the customers didn't bring some. Probably some of the customers brought some of the goods due to default, or let me say damage or wrong prescription or anything. And when the customers are bringing some of the goods to you, we call it return inwards. When you, the owner, you buy goods and return it to your suppliers or your payables, we call it return outwards. So here we start with the sales and we less return inwards. If some of the customers return some of the goods to you, we less it to get our actual sales, or what we term as net sales. Another name for the return inwards is known as sales returns, meaning returns associated with the sales. So when we deduct, or when we subtract, or when we take the return inwards from the sales figure, we arrive at the net sales. The reason why we do it this way, unlike the way they used to teach us in primary, was that selling price. In accounting, I said is sales, but this sales, it can be in the form that some of the goods or some of the sales you made were being returned by your customers, and for you to know your actual sales or the net sales, we have to deduct that return was. So when you deduct that return was, it will give you the actual sales for the period or for the year. That is for the sales aspect. Then we are coming to deduct the cost price. But in accounting, as I said, we don't just have cost price. In accounting, we keep on saying that the price of an item or the cost of an item is not only how much you acquired or you bought the asset for, but any cost incurred in bringing the goods to your premises or to its original position. And therefore, our cost price in accounting is not going to be only the cost price you incurred in acquiring the asset. Any cost incurred, incidental cost, any cost, TNT, all those stuff. So the format, after you dealing or after you are done with the sales section, you come to less cost of sales. Under less cost of sales, we have opening inventory. Someone will be asking, say, why do we start with opening inventory? And I will chip in that if you are coming to sell rice, and before you go to market and go and buy some, already you have some of the bags of rice in your kitchen, definitely you will take that rice first, pour it. If it is not enough, then you go to the market to go and buy some. So always opening inventory comes first under the cost of sales. So we have our opening inventory. It's the same as opening stock. Then after getting the opening inventory, maybe the opening inventory wasn't enough for the period, so you go and buy additional one. And buying in accounting we term as what? Purchases. So we add our purchases to the opening inventory. As I rightly said initially, any cost incurred in bringing the goods to its original position in your office, at your premises, must be added. So when you get the purchases amount, then you add carriaging was to the purchases. When you say carriaging was, that is the TNT. Ordinary person will say the TNT you incurred in bringing the goods to your office or premises. So you add your carriaging was. If you don't have carriaging was in the trial balance or in your question, don't waste your time. So you add carriaging was to the purchases figure and to the opening inventory. When you add these three, then the same way when you sold to your customers, some of them return some to you. There can be a situation whereby you too, the goods that you bought or the goods that you purchased, you are going to return some to your suppliers. And in accounting, we term it as return outwards. Return outwards. So if you have return outwards in the question, deduct it from the addition of the first three elements: opening inventory, purchases, and carriage inwards. Because that return outwards is not for you. You've returned it and you've taken the money, so it will only be part of your purchases. So you subtract or you less return outwards from the addition of the first three figures. After deducting the return outwards, then you arrive at what we call cost of goods available for sale, and we shorten it as COGAFS. COGAFS, cost of goods available for sale. So when you get the cost of goods available for sale, from the definition, from the name, cost of goods available for sale, that is, these are the real goods that are available for you to sell. And if you check the trial balance, or under the trial balance, you see that the owner couldn't sell all the goods, then definitely the owner is going to get what we call closing inventory. The same way we have opening inventory, we can have closing inventory, meaning the goods left, he couldn't sell those goods within the year. You deduct from the cost of goods available for sale. So when you deduct the closing inventory from the cost of goods available for sale, then you arrive at what we call cost of sales. And initially, that was the heading you put up in your format, cost of sales. So you have arrived at the cost of sales. When you get a cost of sales, it will be in the second column. Mind you, the format we have here, we don't have debit credits. It's just a subtotal and a grand total. So when you get a cost of goods, a cost of sales figure, you place it under the net sales column. You deduct it from the net sales to arrive at gross profit. So when you get the gross profit, that is your profit for the year. Anything attached with gross means that it hasn't finished with respect to the deductions. It is gross, meaning there are other things you have to deduct, or there are other things you have to add. So when you get a gross profit, the first thing you have to do is add other income. When you say other income, any income you are realizing as a result of the position of your business, wherever you are, maybe that income might not be your main or your actual activity of the entity, but you are making that income as a result of you being there. One of these other income can be discount received, it can be commission received, it can be rent received, it can be, name it, it can be profit on disposal. Maybe you were selling one of your cars and you made a profit. When you make a profit, it's an income, but this is not your actual income, so we call it other income. You add all this and add it to the gross profit to arrive at your total income. After getting your total income, then I keep on saying you come to your operational expenses. These operational expenses can be known as indirect expenses. That is a type of expenses that you, the owner of the business, you are incurring, but it is not directly attributable to your final product. Example, electricity charges, telephone bills, salaries and wages, rent and rates, name it, depreciation of your non-current assets. They are all indirect expenses. That is why sometimes business owners will start their business and people will calculate for them, hey, they are making profit. Oh no, there are other indirect expenses they are making that you, the end user of the statement that the owner is preparing, you might not even have an idea about. So you deduct all these expenses from the total income. When you finish and the total operational expenses is lesser than the total income, then you are getting a net profit. But in a situation whereby the total expenses or the total operational expenses is higher than the total income, then you arrive at what you call net loss. And when you are making loss, it means your capital or your equity will be going down. If you are making profit, it will increase your capital. Thank you. I'll bring to you the next episode on how to do this in a real or practical form. Thank you.